So hi guys, this is SJ speaking, and in today's video we're going to see about what is MSF rate. So before going to the video, I'm personally teaching trading. So if you want to join my mentorship course, I'm providing 7 courses. You can enroll in any one of the 7 courses. So I am taking technical analysis, price action, and technical analysis, master strategy, and fundamental analysis. You can get them separately or combined together or all of them together in a single package. So totally 7 courses. If you're interested to have the details, you can contact me from the number in the scrolling below on my video. So now let's go into the video. So let's see what is MSF and MSF rate. So MSF stands for marginal standing facility. So MSF rate refers to the interest rate that the RBI charges the scheduled commercial banks for borrowing funds overnight from them by pledging government approved securities as collateral. So why I gave the word RBI instead of central bank is because in other countries such as USA and other countries, they also have these schemes and facilities, but they have in some other name. So this marginal standing facility was introduced by our country's India's central bank, Reserve Bank of India, in 2011 monetary policy. So this is the marginal standing facility. So this is borrowing funds from the RBI overnight. Within 24 hours, the banks must repay them. And this is only available for the scheduled commercial banks. So I will explain the difference between scheduled and non-scheduled commercial banks later in this video itself. So the RBI doesn't give the funds simply, it asks some collateral. So only the government approved securities are given as collateral in case of MSF. So there is also no selling and repurchase agreement. There is no selling and repurchase agreement taking place. They are just given as collateral to the RBI. So marginal standing facility is used by the banks only if there is acute liquidity shortage. So acute means nothing but it's sudden. If the bank suddenly needs money in case of emergency, the banks usually borrow under this MSF from the RBI. So suppose if the many customers, many business corporates might have banks current accounts with the respective scheduled commercial banks. Suppose the bank only has 500 crores, but the withdrawal is for 750 crores, means there is 250 crore rupees shortage. So this amount is borrowed from the RBI overnight and given to the customer. So MSF is only applicable for the scheduled commercial banks that have current account and SGL account with the RBI. SGL refers to subsidiary general ledger. So we can see about this SGL in a separate video. I'll bring a separate video regarding this. So this is the thing. And next thing, what is the minimum account to be borrowed under the MSF means 1 crore. Below 1 crore you can't borrow. So 1 crore is the maximum. And multiples of 1 crore you can buy. 1 crore, 2 crore, 3 crore, 4 crore you can buy. So banks can borrow funds maximum up to 1% of the NDTL. So NDTL means it refers to the net demand and time liabilities. So demand liability means the bank is liable to pay the amount upon the demand of the depositor. Suppose if you are depositing, we are depositing some amount in the bank. On the demand of us, they have to repay back the money to us. If we are demanding around, if you are taking around 250, for example, if you are deposited around 10,000 rupees, if you are taking that, the bank is liable to pay that upon the demand of us. So this is what is known as demand liability. Time liability means, suppose if you are having FD, if you are having FD for around 10 years, 3 years means after this 3 years, the bank is liable to pay the amount along with the interest to the depositor, to the FD depositor. So this is what is time liability. So suppose the total net demand and time liability is 100,000 crores means the 1%, 10 crore the banks can borrow under the MSF facility, or the banks can borrow up to 1% of SLR. SLR means nothing but statutory liquidity ratio. I'll bring a separate video of SLR, but in this video I will explain it. SLR means it is the sum of the money that the bank stores as suppose if the bank SLR is 18%, means the current rate is likely 18%, but for example take 18%. So RBI gives this SLR, if the RBI gives this SLR as 18%, means then the total deposits, net demand and time liabilities, 18% the bank has to store in the form of cash or gold or government securities. So this is only for the safety of for the bank. Like I've told you, the bank follows a method called fractional banking. For example, if the deposit is 10,000, if 1,000 crores is deposited in the bank, means then 80% of this 10,000 crore is given as loans. Only 20% or 10% is maintained. Generally, I'm speaking. So if the 18% is SLR, means from the 1,000 crores of the deposits, total net demand and time liabilities, the bank has to store 18% in the form of cash, gold or government securities. So 6% in cash, 6% in gold and 6% must be invested in government securities. So this is for the safety of the bank. In order to avoid bankruptcy of the bank, the RBI gives this rate, this SLR ratio. So this has to be maintained. From this 18%, 1% can be borrowed as money from the RBI under the MSF facility. So either 1% of NTTL or 1% of SLR. I will come back. I will explain it deeply in later in the video. So before explaining it, I will explain about what is the difference between scheduled commercial bank and non-scheduled commercial bank. So a bank is categorized as scheduled commercial bank if it has at least 5 lakh as paid up share capital. So paid up capital must be 5 lakhs. So at least 5 lakh if the bank has paid up capital, means it is categorized as scheduled banks. So less than 5 lakh means it is non-scheduled banks. So what is paid up capital means without borrowing money, if the capital is 5 lakh is raised by selling shares from the shareholders money. Basically it's the shareholders money worth of 5 lakhs. So this is what paid up capital. Without borrowing any money, if the bank sells the shares and raises 5 lakh capital, means at least if it has 5 lakh capital, means it is scheduled commercial banks. Only the scheduled commercial banks that have current account and SGL account with the RBI are applicable for getting borrowing loans under the MSF facility. Other banks can't get. And you might wonder why the banks getting loans from the MSF, rather than they can get from the repo rate. Repo rate is given for a short term, for example 3 days, 4 days, or even it can be for weeks. So instead of paying overnight, repaying back the overnight, the bank can get the repo. So suppose if the bank has already, bank can have excess number of government securities. So if the bank doesn't have excess number of government securities, they can't get, suppose if the government has excess number of securities, it can get loans under repo facility. But suppose there is no excess number of government securities, means the government can take the government securities under the SLR. Under the SLR, it might have invested some amount in the government securities. The bank can even give these kind of government securities as collateral under the MSF facilities. You might wonder, so this is for the safety of the bank. It is taking 1% of the SLR. So this is SLR is already given by the RBI for the safety of the bank. So how the bank can given, you might wonder. So this MSF is only for overnight. So within 24 hours, the bank will repay the amount to the RBI. So along with the MSF rate, that is the interest rate. The current interest rate is 4.25%, the MSF rate. So along with overnight, the repayment is done. So that is why even from the SLR, the government securities are given as collateral. So this is the difference. Suppose if you are not having that much government securities, you can use the MSF facility because you can't use the repo facility. So that is why. So if this MSF rate increases, the loans are expensive to get from the RBI. So the banks will avoid getting loans and the money supply can be reduced. And if there is economy, there is inflation in the economy, this can be reduced. And similarly, if there is deflation, means the money supply can be increased by reducing this MSF rate and along with the other interest rates. So apart from that, if you increase this MSF rate, you can also increase the value of the rupee against the dollar. So you can strengthen the Indian rupee. The domestic currency's strength can be increased by increasing the MSF. So other countries might invest in our country. So the demand for our Indian rupee can increase and the supply is also reduced. So this can also be done by altering the MSF rates. So this is what the MSF means, the difference between the repo and MSF. You might have got a clarification. So this is also decided by our RBI's monetary policy. So current MSF rate is 4.25%. You can simply type it on Google and see the current MSF rate or any other rate that you want to watch. So my videos can be useful for the not only for trading and investing. My videos can also be useful for so the bank who are preparing for bank exams, or if you want to do some career in these financial fields, my videos would be useful. So if you like the video, like, share and subscribe, and also press the bell icon. And if you want to learn trading from me, you can contact me from the number below. And if you want to open a Demat or trading account, there is link in the video description. All my YouTube videos, you can open the link and you can open your trading and Demat account. So thank you guys. I will see you on my next video, and until then, bye bye, take care.